In today's world of endless market volatility and news about upcoming recession, meme stocks, AI hype, and interest rate drama, losing money has practically become a norm, as people not just depressed, but also making memes about it. You got guys sitting on their desk day trading, watching stock prices going up and down, while being in red and leveraged 2 to 1. And this phenomenon is not just for the amateurs. Even hedge funds like Melvin Capital, to famous financier investor like John Malone to your ordinary index fund investors, and of course Reddit degenerates, everyone's losing money. Just differently. So today, we're doing what any responsible investor would do, ranking every type of investor into a tier list to see which type of strategy generates highest alpha. Of all the strategies out there, value investing arguably wears the crown, thanks to legends like Warren Buffett, Charlie Munger, and Seth Klarman. The idea is simple: buy a solid business when it's undervalued, then wait patiently for the market to catch up. It's slow, steady, and annual report heavy, but it works, as proven by Buffett's decades-long 20% annual returns. That said, value investors have their quirks. They're proudly contrarian, often avoiding anything popular, including tech stocks that later destroy their entire portfolio. They missed Amazon, skipped Google, and thought Netflix was a DVD store. They also treat Buffett like a prophet, quote Mr. Market, and reread security analysis without understanding SaaS companies, as it is not within their circle of competence. Their motto? Be greedy when others are fearful, until their stock drops 30% and they panic. In theory, it's buy low, sell high. In practice? Buy low, hold forever, and talk about value being out of favor in interviews. For value investing, it is the best strat for long-term investing, and been proven by Buffett and Munger. And for having pretty insightful principles like Mr. Market, contrarianism, and circle of competence. And from all the investing strat we going to talk about in this video, this is the one that makes most sense. So, I will go with S tier. Next, we got the growth guys. Growth investors don't care much about profits or cash flow, they care about potential. If a startup uses AI, blockchain, and buzzwords like disrupt, it's instantly a hot pick. Inspired by visionaries like Cathie Wood, they chase big ideas, huge markets, and hockey stick growth charts. In bull markets, it feels like magic. Stocks triple, everyone thinks they're a genius, and Reddit is full of posts like $hypertech is the next Tesla. Some guy turns $3,000 into $9,000 and starts a newsletter called The Growth Gospel. Then interest rates rise. Reality hits. Stocks crash 80%, portfolios bleed, and Cathie Wood goes on TV saying, "We're still confident." Meanwhile, Reddit is full of bag holders saying stuff like, "Just average down on $EV Cloud AI. I believe in the vision." They hold not out of courage, but because selling would admit defeat. One meme says it all. Me holding growth stocks while eating instant noodles, at least I'm early. At its best, growth investing feels like buying the future. At its worst? Just expensive dreams with no earnings and a lot of dreaming. Growth investors have generally done well with investing. But the only problem is the valuation, where this growth stock trade at. Some trade at 30 times to even 50 times earnings. And if a recession hits or if the companies miss earnings estimates, then the growth investor's gonna get cooked. Because of that, I cannot give S tier for this. You can easily find a lot of pretty good high to mid single-digit growth in cheap value stocks. So, why take the risk of overpaying for growth? With that, growth investing goes to A tier. Quant investing is Wall Street's nerd zone, where geniuses sit in offices, trading algorithms, outguessing chart patterns. Feelings? Not allowed. Just math, models, and machines that trade in microseconds. Renaissance's medallion fund pulled in 66% per year before fees. That's not investing for most people, that's wizardry. Naturally, retail traders wanted in. So they grabbed free Python scripts ChatGPT generated. Back-tested on their 3-day moving average crossover strategy with 2 years of meme stock data and bragged on Reddit. My model has a 94% win rate, am I the next Renaissance? On paper, they turned $10,000 into $30 million. Then they go live and lose 30% in 5 minutes because the model didn't factor in real-world stuff, like CPI reports or earnings. That's the problem with quant dreams. They work until they don't. Don't forget that, for most retail investors like us, being a quant is basically impossible. But there is a lot of jobs for math geniuses in Wall Street and it pays well. This goes to A tier. I am putting it here because I can't realistically use any of QuantStrat to make money. But it is profitable. Next we got Soros macro wannabes. Global macro investing is galaxy brain finance, 6 monitors, 12 currencies, and endless espresso. Legends like George Soros made billions shorting currencies, and Ray Dalio's still writing his books. These hedge fund giants bet big on things like GDP, central bank moves, and geopolitical shifts. Naturally, retail investors want in. One reads a few pages of principles, stares at a TradingView chart, and tweets. The Swiss franc is about to implode. Going all in. Hashtag macro alpha, hashtag Dalio mode. Then the Swiss National Bank does nothing, and they're down 78%, wondering if they can cancel trades after hours. Some go even deeper. Based on Chinese real estate and Peruvian copper futures, Jerome Powell will sneeze hard next morning and the S&P 500 will crash 40% by Thursday. It doesn't. Instead, the market rallies because Jerome Powell sneezed early at his bathroom before the news. Macro investing feels smart. You say rate differentials, wear a suit at home, and explain why you're long soybeans and short the euro. But when the market moves on a banana shortage in Panama, your thesis blows up. For most retail traders, global macro ends up being vibes, overconfidence, and leverage. The only global shift they see is their portfolio and their girlfriend leaving. Because how difficult it is the predicted economic event, and I don't even know how most of this trades even work. I am putting this into A tier. Then, we got index funds and dividend investors. Also known as Warren Buffett said, and he loves Coke and bank stocks that pays big dividends. Index investing is like wearing a beige sweater, not flashy, but it wins. Jack Bogle said, just own the whole market and take a nap, and Million said, say less. Enter the retail investor, scarred from Tesla calls. Alright, I'm done gambling. Just bought SPY. Time to chill and let compound interest cook. 3 weeks goes by, and their holding is down 0.8%. Retail brain, what the duck is this? Then the market drops 5% and they panic. Is indexing broken? I'm down $94. Should I go to cash? And the wise boomers say, you don't trade the index. You marry it. But it gets boring. No moonshots. No dopamine. Just tiny quarterly dividends that feel like couch change. So they get tempted. Adding a little spice, bought 10% ARK. For the culture. And now the portfolio is 40% VTI, 20% VTI leveraged, 10% Tesla, 10% small cap Chinese tech, 10% covered call ETFs, and 10% chaos. Then they discover dividends. Wait. I just buy a stock and it pays me? That's free money. So they ape into AT&T, MO. 6 months later. AT&T slashed the dividend. MO's flat. And they're down 30% with $97 in passive income. It's fine. I'm reinvesting with Drip. Buddy, you're pouring coffee into a burning mug. Next move? Switching to QYLD for monthly income. This is the real strategy. Sure, enjoy your 12% yield and minus 25% capital losses. Meanwhile, boomers are out here sipping Coke dividends, unbothered. For this one, even if this strat works long term, it's so boring that I'm gonna put it in C tier. Finally, we got the meme stock investors. Meme stock investors don't care about fundamentals, cash flow, or reality. They care about vibes, rocket emojis, and what Keith Gill is doing. Step 1. See a Reddit post titled $Banana is the next Tesla. Step 2. YOLO life savings into it. Step 3. Post a victory lap when it goes up 12% before lunch. Banana to the moon rocket I'm never selling. This is not financial advice. Then it drops 40% overnight and they double down. Still holding, diamond hands. I believe in the CEO's vision. Eventually, their portfolio looks like a crime scene, but they keep posting. Cost basis $94. Current price $3.18, just average down. Easy 10x from here. Why? Because selling now confirms the loss, and in meme stock land, copium is stronger than logic. They're not investing. They're participating in a digital group hallucination with a ticker symbol. Meanwhile, hedge funds short them, CNBC laughs, and the meme stock subreddit is on fire, literally and figuratively. Meme investing can be fun, thrilling, and community-driven. But if your financial plan includes hope and 37 rocket emojis, it might be time to stop and start with index funds and dividend stock. For this one, what else can I say? It's a D tier. And with that, we have completed the tier list. We have covered the important ones, from value investors to meme stock investors. So, I hope everyone is happy with the ranking. And please comment down, what is your preferred investing strat is? And tell me if you want more videos like this in the future. This is Visionomics. Signing out.